Listen carefully. If you think silver is simply a dormant metal that occasionally awakens, you're about to understand why that perspective is fundamentally flawed. Because right now, silver is being pulled simultaneously in three distinct directions: fear, industrial demand, and politics. When these three forces tug the same rope, the resulting snap can be violent. It's Monday, February 9th in New York. Comment what day and date you're watching from. Before we examine the broader picture and connect these elements, I'm doing something unprecedented in February, a silver giveaway. I'm not referring to a small token prize. In December, I gave away slightly over 10 ounces. In January, I increased it to around 20. This month, I'm taking roughly 30 ounces from my personal collection and sending it to one winner. Here's how to enter. Like this video, subscribe, and comment either your preferred silver type, bars, rounds, junk silver, whatever you favor, or share your February silver price prediction. That's it. Straightforward. Complete those three actions and you're entered. Good luck. Now let's address what actually matters. The reason this giveaway even makes sense. Because if you've been watching markets lately, you can sense it. Not just volatility, it's more like the market holding its breath. Stocks surge one day, plummet the next. Bonds appear calm for a week, then jerk around as if someone flipped a switch. And metals. Metals are exhibiting that behavior where half the crowd is declaring top, while the other half whispers, "This hasn't even started." So I brought in someone I trust to think clearly when everyone else is panicking. David Bush. He's a CFA who helps manage investments at a major wealth firm, meaning he must translate messy headlines into decisions that actually hold up over time. I asked him a simple question with a complex answer. Are gold and silver about to cool off, or are we about to be surprised to the upside? He laughed slightly because if you've ever tried predicting day-to-day metals moves, you know it's like trying to forecast the next wind gust. But then he said something memorable. Gold remains the place people flee when they don't trust the room, when the dollar feels unstable, when politics gets loud, when risk starts spreading like smoke. That hasn't changed. What's changed is why silver keeps appearing in the same conversation. Because silver isn't just a store of value narrative. Silver is a store of value narrative plus a we actually need this material narrative. You don't simply vault silver, you consume it in products, solar panels, electronics, sensors, industrial parts most people never consider. That's where tension originates. Let's discuss something most people skip because it's less exciting than price targets: supply. Silver doesn't have the same clean, centralized vault narrative that gold has. Much silver gets mined as a byproduct of other metals. So if the world slows in copper or zinc, silver supply can tighten even when nobody is bullish on silver. When demand climbs simultaneously, that's how you quietly build pressure. You'll hear people say, but we can just mine more. Perhaps. But mines don't activate like light switches. Permits take time. Capital takes time. And with many metals projects, the hurdle isn't just geology, it's politics, financing, and the willingness to take risks when prices are unstable. That's why recent industry surveys keep noting that industrial fabrication has been strong, even while the supply side doesn't magically surge overnight. Here's an important gap. Silver is not a huge market compared with the oceans of money sloshing around in equities, bonds, and even gold. So when new money appears, when investors decide they want exposure, silver can feel like a small room with a large crowd pushing through the same door. That's when you get those sudden moves that make people ask, how did that happen so fast? And it's not just futures traders. When physical buyers become active, coins, rounds, small bars, the retail side can tighten local availability quickly. The global price is one thing, the street price is another. When those two start drifting apart, it indicates demand is showing up in the real world, not just on screens. Now, does that guarantee a rally? No. Silver can still get slammed in a risk-off liquidation. It can still get dragged around by the dollar. It can still get whipped by leverage. But it explains why silver can go from ignored to center stage almost overnight, because when it turns hard. That sets up the next question I asked David. If silver has both a monetary story and an industrial story, which one matters more right now? Because gold can go quiet and still be gold? Silver can't go quiet without somebody somewhere losing a supply chain bet? Based on recently published numbers, industrial demand for silver has been pressing into record territory, with solar doing much of the heavy lifting. Here's the part people miss. Even when manufacturers try to reduce silver usage per unit, overall volume can still climb because the world is building more of the things that need it. So silver ends up with this split personality. When fear rises, people treat it like money. When the economy builds, the economy treats it like a raw material. That's why price action can look strange. It can sell off when you'd expect it to rally, then rip when you'd expect it to rest. David's perspective was essentially, don't expect a clean straight line. You might get mean reversion, you might get choppy action, but the underlying demand picture is not the same as years ago. And right as we're discussing that, the conversation took a hard turn into something you don't usually hear in a precious metals interview: artificial intelligence. Because whether you love AI, hate it, or don't care, the spending is real and substantial. That question leads to a bigger point about the AI build-out that most people aren't pricing correctly. AI isn't just software. It's concrete, steel, transformers, long delivery times for chips and networking gear, hiring electricians and construction crews, buying land near cheap power, and signing electricity contracts that run for years. That's why this spending wave doesn't just benefit tech, it spills into energy, industrials, materials, and the unglamorous middle of the economy. From recent market updates, you can see policymakers and companies openly discussing the strain this build-out can put on supply chains and grids. Here's the cliffhanger within the cliffhanger. When a boom like this happens, the winners aren't always the companies spending the money. Sometimes the winners are the companies selling the shovels, but sometimes the biggest winner is inflation. That's where the AI is disinflationary argument gets tricky. Sure, automation can reduce labor costs in some places, but if you're building massive physical infrastructure in a tight labor market with tight equipment supply and energy constraints, that's not automatically disinflationary in the short run. You can absolutely have a world where AI makes certain services cheaper while the build-out makes physical inputs more expensive. And silver sits right in the crosshairs of that because silver appears in electronics connections and industrial systems, not always in huge amounts per unit, but across an enormous number of units. That's why the solar story matters, why the electronics story matters, and why the build-out story matters. It's not about one gadget. It's about an entire economy leaning into electrification and data. So when people say silver is just a precious metal, they're missing the point. Silver is also a supply chain metal, and supply chain metals don't behave politely when the world races to build simultaneously. Now, take all that spending and add one more ingredient. What happens if the spending continues but profits don't show up fast enough? Because that's when investors start demanding cuts, not in rates, but in budgets. If budgets get cut, the demand story changes. So you're watching two clocks at once, the build clock and the payback clock. Whichever one wins sets the tone for markets. David said, look at what the biggest tech companies are committing to build. Not nice to have software features, but physical infrastructure. Data centers, power, cooling, networking, warehouses full of chips and servers. When you add it up, it's not a few billion or even a few tens of billions. It's well north of $500 billion aimed at AI build-out in the near term, according to recent market updates and company guidance. Just pause there. Think about what that means. These are companies that built their empires on being asset light, and now they're turning into industrial scale builders. One of them is talking about spending in the ballpark of a couple $100 billion on its own just to expand the machine. That raises the exact question David kept circling back to. Okay, but do they get paid? Can they monetize AI at a level that justifies that kind of spending? Because if they can, this is the next big platform shift. If they can't, you're looking at one of the most expensive overbuilds in modern corporate history. I'm going to be honest. This is where I push back a little. The popular narrative you hear in markets right now is massive capex equals massive opportunity. Sure, there will be winners, but winners doesn't always mean shareholders win right now. Sometimes the winners are the suppliers and builders while the big names chew through cash. Sometimes the winner is the utility company selling power. Sometimes the winner is the boring industrial that makes switchgear and transformers. Sometimes the winner is the bond market collecting interest while the hype cools, because a spending cycle can be real and still be a bad deal at the top. Markets know that. That's why every earnings report is getting treated like a courtroom. Analysts aren't just asking, how much did you spend? They're asking, show me the payoff. Until that payoff is obvious, you're going to keep getting headline whiplash. One day the story is, AI is changing everything. The next day it's, where's the money? Here's the twist. When you build AI infrastructure at that scale, you don't just need chips. You need the ingredients that go into the parts that go into the chips. You need minerals, magnets, materials that are not evenly distributed around the world. That's where David got genuinely excited. Rare earths. Because rare earths sit in the background like the wiring in your walls. You don't think about them until you can't get them. Then suddenly, everyone cares. If you've been paying attention to geopolitics, you've probably felt this shift already. Countries aren't just competing on software, they're competing on supply chains. And the rare earth supply chain, especially the processing side, has been heavily concentrated in China for a long time. In some categories, it's not a little bit, it's most of it. This is where rare earths become more than a cool fact. They become leverage, because it's not enough to have ore in the ground. You need separation, refining, processing. And that middle step has been the choke point. Publicly available briefings keep highlighting that China's grip has been strongest in processing and that the United States and its allies are trying to build redundancy without blowing up costs. That's also why you're seeing the stockpile approach. Basically build breathing room. If you can hold weeks of material, you can ride out a sudden export restriction or supply shock. It's not a permanent solution, it's a seatbelt. And it tells you something. Governments are now treating minerals like strategic inventory, not just commodities. Now, about the landfill and recycling angle, I love the idea, I really do, because it's the most American solution imaginable. We already have the junk, the logistics, the landfills. So why not turn a problem into a resource? But here's the skeptical part. Recycling is not magic. You don't just wave a robot arm over a pile of old electronics and suddenly get pure material. You need sorting, chemistry, compliance, and economics that work when prices fall. That's why a lot of recycling projects scale in steps, not all at once. And it's why government support shows up. Funding opportunities, pilot programs, and partnerships meant to bridge the gap between lab success and industrial scale. So yes, landfill mining can help. Yes, urban mining can shorten timelines, but it won't replace mining overnight. The point is diversification, multiple pipes feeding the same system. Because in a supply chain war, single points of failure get exploited. Now connect that back to AI. AI hardware needs magnets. Magnets need rare earths. Rare earths need processing. Processing is geopolitics, and geopolitics leaks into markets through volatility. That's the real story. It's not rare earths are cool. It's rare earths can stop the machine. When the machine looks stoppable, investors start paying up for anything that looks like security. Sometimes that's defense stocks. Sometimes that's domestic producers. Sometimes that's gold. And sometimes it's silver. Because silver is the smaller cousin that can move faster when attention hits. That's why you're seeing all these moves around stockpiles, partnerships, and industrial policy. Just in the last couple of weeks, we've seen talk of building a strategic reserve and coordinating mineral supply with allies, basically treating critical minerals like a national security asset. I know people hear rare earths and their eyes glaze over. So let me make it simple. If you want high-performance motors, advanced defense systems, and much of the hardware that sits behind AI, you need rare earth magnets. And if the refining and processing is bottlenecked, the entire chain gets fragile. That fragility is why David brought up this mission idea. He'd been investigating an initiative focused on getting minerals from places we've ignored, not from a brand new mine that takes nearly a decade to permit and build, but from waste, from stuff we've already thrown away. Because the truth is, the easiest new mine might be the one we already built in the form of landfills. When you hear landfill mining, it sounds like science fiction, but the logic is straightforward. For decades, we tossed electronics, cables, appliances, and industrial junk into piles. In those piles are traces of the same materials we now claim are scarce. David's point was, if new mines take forever, the pressure builds to extract from the urban dump. And here's where it gets wild. The process isn't just dig it up and hope. The process is becoming automated. AI vision systems to identify what's valuable, robotics to disassemble hardware quickly and safely, then specialized recycling and purification to turn that scrap into usable material. Again, that whole AI helps AI loop is real. You can see public programs now funding recovery from discarded electronics and other waste streams to strengthen domestic supply. Now, let me be clear. A lot of the most innovative companies doing this are still private, so you can't just buy a ticker and call it a day. But the theme matters, because it changes the timeline. If you can recycle rare earths faster than you can permit a mine, you don't need to wait nearly a decade for incremental supply. You can pull supply forward. That ripples into everything. Defense, energy, technology, and yes, precious metals. Because the same industrial build-out that pushes rare earths also pushes silver. See the connection? Solar panels don't care about your macro thesis. They care about conductive metal. Data centers don't care about your feelings. They care about reliable inputs. And when the world starts racing to secure inputs, prices don't always move politely. Sometimes they gap. Sometimes they overshoot. Sometimes they scare everybody out right before they move again. Okay, now we have to talk about the thing that sits over all of this like a ceiling fan, interest rates. Because rates are the gravity in financial markets. Rates shape the dollar, credit, and the cost of all this spending. The next few months are unusually spicy because the Fed is staring at a leadership transition window. Jerome Powell's chair term runs out in mid-May 2026, while his seat on the board can run until late January 2028 if he chooses to stay. In recent headlines, Kevin Warsh has been floated, more than floated, as the nominee to take the chair, pending confirmation. You might have noticed the naming around that rumor has been sloppy, with different versions floating around. Let's clean that up. The name that keeps showing up in public reporting is Kevin Warsh. His public posture, at least as it's being described, has a split-screen vibe. On one side, there's the argument that productivity, especially from AI, can be disinflationary, so short-term rates can come down. On the other side, There's the push to shrink the Fed's balance sheet more aggressively, which can put upward pressure on longer-term yields through term premium and liquidity dynamics. That's the curve steepening story. Short rates down, long rates sticky, or maybe higher. Yes, that kind of curve can benefit certain parts of the financial system. But here's my skeptical take. A steepening curve isn't automatically good. Sometimes a steepening curve is the market saying, we don't trust the inflation story. Sometimes it's the market pricing bigger deficits. Sometimes it's the market demanding more compensation for holding long-term debt. So if you're watching silver and gold and think rate cuts equals metal's moon, slow down. It's not that simple. Because if the front end drops, but the long end stays firm, the real-world borrowing costs that matter for mortgages, business loans, and infrastructure can stay heavy. That changes the whole vibe. It's also why you can get this weird scenario where the Fed cuts and the dollar doesn't collapse, or where the Fed talks dovish and long yields refuse to cooperate. We've seen versions of that before. Now add one more layer: Fed, politics, and independence. With politics getting louder, the Fed transition has turned into more than just a normal handoff. There's a lot of noise swirling around the institution, and markets can't ignore it. Whether you think that's noise or signal, markets don't like uncertainty at the top. So when David says, expect volatility around headlines, he's not being dramatic. He's being realistic. That volatility doesn't just hit stocks. It hits metals, currencies, and the part of the bond market that everybody pretends is boring until it isn't. One more thing about that Fed story that people underestimate. Even if a new chair comes in with a strong opinion, the Fed is not a one-person show. Policy is set by a committee. Votes matter. Consensus matters. That's why the market often overreacts to the new sheriff narrative, because the chair can influence the conversation, but can't just snap their fingers and rewrite the entire playbook. Also, balance sheet policy is its own beast. Quantitative tightening doesn't hit like a headline rate cut. It hits through plumbing, through reserves, through the term premium investors' demand for holding longer-term bonds. Fed officials have openly discussed how balance sheet decisions can translate into changes in longer-term yields. So when people say short rates down, long rates up, they're not making that up. But the range of outcomes is wide, and the market can shift that range quickly. A single line in a press conference can move expectations. A single weak inflation print can pull yields down. A single geopolitical shock can flip everything risk off. If you're holding metals, you're not just watching the Fed, you're watching what the market believes the Fed will do next. Because belief moves faster than policy. Sometimes the biggest moves happen before the Fed does anything at all. That's why I tell people to stop trying to win the next meeting. Win the next cycle. If you can do that, the noise becomes background. At this point in the conversation, I asked David the uncomfortable question: what if this AI profit story doesn't land? What if we build all this infrastructure and the payoff is smaller than the hype? He didn't sugarcoat it. Earnings drive stock prices, not vibes or press releases, earnings. So if AI doesn't show up in the numbers, the market will punish the names that spent the most. If you think that doesn't matter for silver, think again, because the silver story sits on that same industrial build-out. If the build-out slows, silver's industrial demand story can cool at the margin. But if the build-out continues, even if big tech isn't the main winner, the metal still gets used. That's why silver is such a strange animal. It's tied to optimism and fear at the same time. Now, if you're listening and building your own plan, here's the question you should be asking yourself. Am I trading headlines, or am I positioning for cycles? Because David's advice was not chase. It was stay patient, think long-term, stay invested, and don't let a few wild days trick you into making a permanent mistake. That's not exciting advice, but it's the advice that keeps people in the game. He also said something I agree with. Even if you believe tech is the future, you don't have to express that belief in just one way. Yes, you can hold the big names, but you can also look at the picks and shovels that benefit when the world builds. Energy producers that feed data centers, industrials that build the physical gear, materials, companies that supply inputs, even utilities and grid upgrades, because AI doesn't run on hype. It runs on electrons. The market has been quietly admitting this. The AI story is broadening. It's not just a handful of mega caps anymore, it's a supply chain story. And supply chain stories tend to be messy, cyclical, and full of surprises. Where do bonds fit? This was one of the more interesting parts of David's guidance because people have been trained to ignore fixed income for so long. But when yields are actually meaningful again, bonds can play a real role. They can dampen volatility, act as a ballast when stocks are swinging, and depending on where rates go, they can even provide decent carry while you wait. That doesn't mean go all in. It means balance. Because the goal isn't to be right every day. The goal is to survive long enough to be right over a long stretch. If you're successful, share your success story in the comments so others can stay motivated. One more thing before we wrap, because this is where a lot of people get tripped up. They hear silver and think the whole thesis is just price. But the bigger thesis is behavior. When confidence in paper promises gets shaky, people look for real assets. When industries expand, they look for real inputs. Silver happens to live at the intersection of both. Gold is the pure trust metal. Silver is the trust plus utility metal. That means silver can surprise you in both directions. It can punish you if you treat it like a lottery ticket, and it can reward you if you treat it like a long-term piece of a bigger puzzle. If you want a mental model for why silver can shock people, think about its size. Gold is a cruise ship. Silver is a speedboat. When the tide changes, the cruise ship turns slowly. The speedboat can flip. That's why silver has a long history of moves that feel disrespectful. Up and down. You'll see long periods where it goes nowhere and everyone loses interest. Then a catalyst hits, sometimes inflation fears, sometimes a dollar swing, sometimes a surge in industrial demand. And suddenly, it's the only thing anyone wants to talk about. In those moments, the market doesn't give you time to get ready. It forces you to decide in real time. That's also why I don't love the idea of building your whole plan on a single prediction. Because the reality is, even if your long-term thesis is right, silver can still scare you out before it pays you. The people who do best with silver tend to treat it like a position, not a bet. They size it so volatility doesn't wreck their sleep. They expect pullbacks. They stay humble about timing, and they keep enough flexibility to add when the crowd is running away. Because the crowd always runs away at the worst moment. And that's the moment that often sets up the next leg. So the question isn't, will silver move? The question is, will you still be there when it does? There's a weird problem in the precious metals world that almost nobody talks about. A lot of physical gold just sits there. It's heavy, expensive to store, and doesn't generate anything while sitting. Our sponsor, Monetary Metals, is built around the idea that gold and silver don't have to be dead weight. They've created programs designed to put metals to work through leasing structures. So instead of paying storage and insurance and calling it a day, you may be able to earn a yield that's paid in metal. Depending on the program and who qualifies, the yields being advertised are generally in the low single digits on gold, and for certain qualified investors, potentially into the low double digits on silver, paid in silver. Final takeaway. If silver shocks the world, it probably won't be because of one headline. It'll be because multiple pressures stack up. Industrial demand stays firm, AI infrastructure keeps building, mineral bottlenecks stay tight, and the rate story gets messy in a way that confuses everyone. That mix can create sudden moves. And when silver moves, it doesn't usually tiptoe. So whether you're here for the giveaway, the macro, or the long-term portfolio thinking, do this. Keep your plan simple. Don't bet your future on a prediction. Build positions you can hold through noise. All right, if you want in on the giveaway, hit like, subscribe, and comment your favorite silver type or your February price call. I'll see you in the next one. Just so we're clear, everything we talked about today is for education and general information. I'm not your financial advisor. I don't know your situation. And nothing here is a recommendation to buy or sell anything. Do your own research, talk to a professional if you need one, and only take risks you truly understand.